Superannuation changes are just around the corner, and what you do now could make a meaningful difference to your retirement. This video walks you through the key updates to super for the 25-26 financial year and how they may impact your strategy. Plus, we share practical steps you might consider taking before 30 June to get ahead. I'm Chris Strano, Managing Partner at Toro Wealth and founder of superguy.com.au. We've helped thousands of Australians plan for their retirement. So if you're new here, make sure you grab a copy of our 6-step super check. The link is in the description. As always, this video is general information, not personal advice, so please see the full disclaimer below. So let's have a look at some of these superannuation changes. Firstly, the super guarantee rate is increasing. From 1 July 2025, the superannuation guarantee, which is the minimum contribution your employer must make into your super fund, is set to rise from 11.5% to 12% of your base earnings. So what does this mean for you? You'll notice a small boost to your super contributions. For example, if you earn $80,000 a year, that'll be an extra $400 going into your super annually. And even small increases like these can snowball into something much bigger by the time you retire, thanks to the power of compounding investment earnings. However, keep in mind that the concessional contributions cap will remain at $30,000. So if you're making extra personal contributions or have a salary sacrifice arrangement with your employer, you could find yourself over the cap. And if that happens, any excess contribution amounts will be added to your assessable income and taxed. So what should you do? Keep track of all your contributions that you and your employer are making into your super fund. If you're sitting close to the cap, consider adjusting these arrangements to keep you under. And if eligible, consider utilising your unused concessional cap amounts from previous years. That brings us to another important change this financial year. Unused amounts from the 2019-2020 financial year will expire. Do you have any unused concessional cap space? If so, now's a good time to check in, especially before some opportunities slip away at the end of this financial year. So a quick refresher, concessional contributions are pre-tax payments into super, including SG contributions from your employer, salary sacrifice, and personal deductible contributions. The concessional contribution cap is $30,000 per year. However, you may be able to utilise unused concessional contribution cap amounts from the previous 5 years to increase your contributions this year, provided your super balance was below $500,000 on 30 June 2024. So how might this affect you? Well, if you've had years where you didn't use up your concessional contributions cap, you might have built up some extra contribution room without even realising it. This can be a great opportunity to boost your super and save on tax. However, unused cap amounts expire after 5 years. That means any unused amounts from the 2019-2020 financial year will disappear if you don't use them by 30 June 2025. So what can you do now? Firstly, consider making extra concessional contributions into your super if you're eligible before 30 June 2025 to use up any available carried forward amounts. Make sure you notify your super fund using the approved form if you plan to make personal concessional contributions. You'll also need to receive acknowledgement from the fund, otherwise you could miss out on the deduction. Also, review your total super balance. If your balance is getting close to $500,000, it might be beneficial to find ways to keep your balance under this threshold before 30 June 2025. That way you won't unintentionally lose access to this strategy in 2025-2026 financial year. I've done a full video on unused concessional contributions. Check out the link in the description below. Another change that's about to occur is an increase to the transfer balance cap. From 1 July 2025, the transfer balance cap will rise from $1.9 million to $2 million, giving you a little more room to enjoy tax-free earnings in retirement. The transfer balance cap is the maximum amount of money you can move into the tax-exempt retirement phase of superannuation by starting an income stream like an account-based pension. Any super amounts over your personal cap must stay in your accumulation account where earnings continue to be taxed at 15%. So what does this mean for you? Well, from 1 July 2025, you'll be able to transfer more of your super into the tax-exempt retirement phase of superannuation, but only if you start your pension after the 1 July increase. If instead you start your pension before 1st of July 2025, you'll be locked in at the lower $1.9 million cap and only eligible for a proportional increase of the cap. So if you're planning to retire soon and your balance is around the $2 million mark, consider waiting until after 1st of July 2025 to start your pension. This way you can take advantage of the higher cap and you'll have more of your retirement savings working for you. That said, everyone's situation is different. For example, if your balance is well below the cap or you need the income now, there may be no benefit to delaying retirement. While we're talking about thresholds, another key limit that's about to increase is the total super balance threshold. From 1 July 2025, the total super balance threshold relating to non-concessional contributions will also rise from $1.9 million to $2 million. So if you've been hovering just above the $1.9 million limit and missing out on certain superannuation opportunities, this is welcome news. So just a quick refresher, your total super balance, or TSB, is the combined value of all your super accounts, including accumulation and retirement interests, plus rollover amounts, and adjusted for certain factors like personal injury payments. Your TSB is used to determine your eligibility for a range of superannuation concessions like non-concessional contributions. If your TSB is over the threshold on 30 June of the previous financial year, you won't be eligible for these strategies in the next financial year. You can check your total super balance by logging in via MyGov. The takeaway for you? Well, the increase to the TSB threshold means that if you've previously been just over the limit, you may now qualify for superannuation concessions. If you are at or just over the $2 million mark and you want to take advantage of super strategies that require you to be under that threshold, consider ways to reduce your total super balance before 30 June 2025. For example, if you've met a condition of release, you could withdraw excess amounts to scrape in just under the threshold. As always, seek professional advice to help decide the right action for you. One more thing to keep in mind, if you're retired or retiring soon, your minimum pension drawdown could be increasing. For anyone approaching or already over age 65, here's a general reminder. Your minimum pension payments could change from 1st of July 2025. The minimum pension drawdown is a percentage of your super balance that you must withdraw from your super annually if you're receiving payments from your pension account, such as an account-based pension or transition to retirement pension. These are the minimum drawdown rates for the 2025-26 financial year. If you're turning 65 or another age that bumps you into a new pension drawdown rate on or before 1st of July 2025, you'll move into a higher minimum drawdown bracket from 1 July 2025. You'll need to adjust your pension withdrawal to meet the minimum requirement. In fact, everyone's minimum pension drawdown will be changing because the minimum drawdown requirement is recalculated on 1 July of every year based on your balance and percentage factor. Making the minimum pension withdrawal is important. If you don't, your pension could lose its tax-free retirement phase status. Make sure you check your minimum pension drawdown rate for the 2025-26 financial year and calculate your required annual withdrawal amount. Now, there's 3 important steps that you need to do before July 1, but before we do that, there's one final change worth noting. The defined benefit pension cap is increasing. From 1 July 2025, the defined benefit pension cap will rise from $118,750 to $125,000 per year. The defined benefit pension is an older type of income stream that pays a guaranteed income for life and is generally paid from a government super scheme or life insurance company. It's more common among retired public sector workers. A high defined benefit pension cap means you'll be able to receive more from your defined benefit pension income stream before it becomes taxable. If you're planning to retire soon and want to start a defined benefit pension or a mix of a defined benefit pension and account-based pension, you may want to delay starting until after 1 July 2025. That's when the higher cap takes effect, which could help you get more tax-free income and avoid going over the limit. As the financial year wraps up, it's worth taking time to review your super strategy, especially with the new updates to super rules. Remember, many of these changes won't automatically benefit you. You'll need to take proactive steps. So what should you review before 1 July? Here's a quick checklist. Number 1, contributions. Make the most of your concessional contributions cap and consider making catch-up contributions if you're eligible before some of those unused caps disappear. Number 2, total super balance or TSB. Check to see if you are close to reaching an important threshold such as $500,000, which restricts unused concessional contributions from previous years, and $1.9 million to $2 million, which affects how much you can transfer into tax-free pension phase if you are close, and the non-concessional contribution cap. Number 3, pension payments. Ensure you've met your 2024-25 minimum pension drawdown and check your 25-26 withdrawal requirement. Adjust if your minimum drawdown rate will be increasing. Leaving things to the last minute could mean missing one small detail, one that might cost more than you'd expect. So take the time now and stress less later. Super rules can be tricky, but with some well-informed planning, they can work to your advantage. By getting started now, you could boost your tax-free income, optimize contributions, and feel more in control of your retirement path. Unsure how the super changes affect you? We're here to help. At Toro Wealth, we help Australians 50 plus make the most of the latest changes and optimize their super strategy for ongoing retirement benefits. If you're interested about learning more about our services and costs, head over to torowealth.com.au. If you found this video helpful, be sure to like and subscribe. See you on the next one.